Hey everyone, welcome back to the Weekend Charts. Charlie Bilello here, your host. And as always, we're going to run through a lot of important themes and go through the most important charts that we're seeing today. I want to start out by talking about the bond market. We're going to quickly run through what has happened there in terms of yields, and it's been pretty startling. It's really escalated very quickly here this morning. The 30-year Treasury bond yields crossed above 5% for the first time since 2007. And we got a stronger than expected jobs report that kind of precipitated that. But we've been seeing this rise for a number of weeks pretty sharply here, above 5%. And how does that compare to a few years ago? Well, back in 2020, you probably remember March 2020, we hit an all-time low in this 30-year Treasury yield. So in just a few years now, we've gone from an all-time low to the highest we've seen since 2007. Pretty remarkable. The 30-year Treasury bond back then was below 1% for a brief moment in time. So investors were so scared about the economy, talking about deflation, talking about a Great Depression, that they were rushing in to buy these 30-year Treasury bonds and pushing that yield all the way down below 1% back then. Today, very different story. The bigger fear, of course, is inflation. And that's driven up yields across the board, not just Treasury bond yields, but also looking at the corporate bond market, yields are rising there as well. Investment grade bond yields, 6.3%. That's the highest since June 2009. Back in 2020, you probably remember me writing a series of articles about investment grade bonds, high yield bonds, a number of Treasury bonds, the low yields portending the low returns. I had one article saying this is the worst risk reward in history in terms of looking at investment grade bond yields. Simply, you weren't being paid anything. You were taking an enormous amount of risk for very little prospect of reward. And what has happened since then? Well, investors have learned there's definitely risk in the bond market. We've seen the LQD ETF have a drawdown over 20% here. That's the biggest corporate bond ETF. And then you have things like TLT, which is the long-term Treasury ETF, down almost 50%, and the zero coupon bond ETF down 61%. And how big of a decline is 61%? Well, it's enormous. It's something you may expect from the stock market, but definitely not from the bond market. It's actually bigger than any drawdown we've seen in the S&P 500. You have to go back to the Great Depression to find a bigger drawdown. So even during the dot-com bubble breaking and the global financial crisis, the S&P 500 never declined more than 60% on a total return basis. And here we have what's supposed to be a safe bond ETF down over 60%, which goes to show you that there is definitely risk in the bond market. And when you're coming from extremely low yields, all-time low record yields, it's almost entirely risk. And investors have learned that lesson the hard way. The good news is that the future is going to be brighter for bond market investors. And across the board, we're seeing higher yields today than the end of 2021. So in less than 2 years, you've gone from 0% on your cash. Remember the saying, cash is trash, to earning 5.6% on this 3-month Treasury bill. You went from earning 1.5% on a 10-year Treasury bond to 4.8%. Investment grade bonds, 2% to 6%. High yield bonds, 4% up to 9%. REITs, 2% increase in the yield there, and S&P 500 dividend yield just a little bit higher. So across the board, investors in a better position today than the end of 2021. Question you're probably asking, is it going to get even better from here? The answer, nobody knows. But what we can say for sure is there hasn't been as good a time if you're a bond market investor. You have to go back to 2007 or before that to find a better time for the bond market than today. Looking forward, right? So we know this has been the worst bond bear market in history, and I'm going to touch on that in a little bit. But looking forward, the future returns from bonds should be better prospectively than at any point since 2007. So mortgage market, obviously higher rates, not good for the mortgage market. We're seeing the highest mortgage rates now since December 2000, 7.49% on that 30-year fixed mortgage rate. And what that is doing to affordability, it's absolutely crushing it. So if you have $3,000 a month to spend on a home, back in 2021, when interest rates were at an all-time low. 2.65% on a 30-year mortgage seems absolutely insane today that rates got that low, but they did. You could have bought a house that was $641,000 in value. Today, with interest rates at 7.5%, you can only buy a $426,000 house. And that's a over a 34% reduction in terms of your what you can afford. And so your purchasing power has gone down by 34%. And that means $215,000 less house. And so, how are people responding to this? If you're in the market to buy a home, what are you saying? You're saying, I'm going to put that off. I'm not going to apply for a mortgage to today because this is crazy. I don't want that lower priced house. I'm going to wait either till home prices come down or until mortgage rates come down. So this is being reflected in the purchase index here from the MBA, and we have the lowest number of purchase applications for mortgages since 1995. So pretty simple. The demand for housing has absolutely collapsed. At the same time, how the housing supply has collapsed as well. So people have mortgages of under 3%, so that was 2.65% mortgages. They're not giving them up. They're not putting their homes up for sale. So very little supply, very little demand. The housing kind of stalemate continues. So what else is higher interest rates hitting? Well, it's hitting the building of new apartments. So we talked about housing starts recently, really starting to go back down again. Well, now we're seeing apartment construction starts go down again, 41% decline year over year, and interest rates definitely having an impact here. If you look at the numbers here, you're looking at a 4% increase in terms of the average rate that it costs to finance this construction. So we went from 4% rates in early 2022 to over 8% rates today. That's a huge difference, of course. And if you're doing the math on whether or not you should start a construction project and your financing costs went from 4% to 8%, well, that's going to have a big impact. The other factor I would say is that the fundamentals are starting to look a little bit worse. If you look at apartment vacancy rates, they've been trending higher here now, highest levels we've seen in some time. So if there's going to be higher vacancies, more difficult perhaps to rent that apartment out, we're seeing rental prices kind of flat to down on a year-over-year basis as well. So certainly builders thinking about that as well. And a final reason would be that costs have simply gone up across the board. This being one example here, if you look at insurance cost on properties, we're seeing a over 7% annual increase since 2017. So this is really starting to compound. So it's not just insurance, of course, it's obviously the cost of building and labor and everything else. And the fact that people can't really quantify what inflation is going to be. So there's more uncertainty about the future inflation rate, and that's leading to hesitancy as well. So for all these reasons, we're seeing a big decline in the number of new apartments being constructed. So what else in terms of interest rates? We're seeing this long and variable lag really starting to hit home here. But if we look at the office property market, it's definitely hitting there as well. And there, it's not just interest rates, but it's also the fact that people are simply not coming back to the office every day. So here we have this data from Castle Systems saying less than 50% have come back to work still. So at this point, I think this is across 10 major cities. At this point, people were expecting this number to be much higher than 50%. How much higher, I don't know, but there's clearly been a structural change in terms of workers' attitudes and companies allowing workers to really come in a few days a week for most companies. And it doesn't seem like we're just going to go back to that 2019 model anytime soon. So what does that mean for the office market? Well, you just have all of this extra supply. When these leases come due, these companies are saying we don't need all of this space, so we're going to get a lower amount of space. Well, that increases the vacancy rates, and of course that puts pressure on the owners of these buildings, particularly if they have debt, and many of them do. And that debt, as we talked about, is starting to come due, and when it comes due, it's going to become difficult to pay back. And this is the market's expectation here. Credit spreads on CMBS, so commercial mortgage-backed securities, widening out here over 1,300 basis points, highest level in over a decade. And what this simply means, investors are expecting a higher rate of default to come. As we've said, this is likely to take years to play out, just because the leases come due over time. This debt is coming due over time, so it's not going to happen all at once. And there's going to be an impact, of course, in terms of the not just the economy, but it's going to impact certain sectors of the market as well. For now, it's really been limited the pain to the banks. If we look at the regional bank index ETF, we look at something like the KRE. If you look at its performance year to date, it really hasn't come back like the broad market did following that March period. So, if we're looking at potential canaries in the coal mine, this would be one of them, I think, front and center for people to think about. How is this going to play out? How is it going to impact the banks who have exposure in their loan portfolios to these securities? And I think the answer to that is going to be it's going to be a pretty long cycle here. We're starting to see places like San Francisco reprice, but you're probably going to need to see that across a number of other cities as well. If you simply have more vacancies and you have the fact that these buildings are worth less because they're not bringing in as much income, well, then that asset has to reprice, and we haven't seen that fully just yet. So let's talk about the investor impact on rising interest rates. It's the longest bond bear market in history. It started back in August 2020 when rates were at record lows, and now we're at 38 months in duration. We're not, this is going to continue. It'll hit 39, 40 months because we're in such a deep drawdown still that even if interest rates fall from here, you're not going to very quickly get back to even. We're now a little over 15% down from the high. And if we look at the last 3 years in terms of the US bond market, 15% losses. That's the biggest 3-year decline we've seen in history for US bonds. And so, pretty incredible. Most people did not expect this 3 years ago. Needless to say, they were rushing into bonds, viewing it to be a safety trade, even though yields were very low. And now I think hopefully they've learned their lesson that when yields are very low, even if things seem bad elsewhere and you think you're getting a safe return on your money, that's the maximum risk point for bond investors. So a lot of investors today saying, well, why should I own bonds at all? Why shouldn't I just have everything in cash and short-term treasury bills? And there would be a few reasons for that. And number one is that you probably need to believe that cash yields aren't going to stay very high forever. So there's no certainty that the Fed is going to leave short-term rates where they are. And when they cut rates, which they will cut rates at some point in the future, we don't know when, that's likely to help the bond market. This is a historical rate cutting cycles going back to 1980. And I pulled the data and showing you here what the Bloomberg Ag did. So what the bond market did. And every single time during these rate cutting cycles, bonds did pretty well. And on annualized returns, very, very well for bond investors. So when the Fed starts cutting rates, and if the market is correct, that's going to start at some point next year, should be a tailwind for bonds. And the broader point is that if the Fed starts cutting rates, it means that there's no permanency to that short-term yield. So could yields stay above 5% for years? They could. But also the Fed could cut them back down to 2 or 1% next year. That variability is the main reason why people take duration risk and go out longer term in terms of bonds. And on that front, your longer term return expectations in the bond market have gone up here. So with each 100 basis point increase in yield, that's a 100 basis point increase in long-term expected returns. All of that's lost in the short term. I understand that when interest rates rise, you dramatically see bonds fall. But looking forward, the single best predictor doesn't change the math of it. The best predictor of returns over the next 7 years is what that yield is today. And the fact that we're at close to 5% on a 10-year means that prospective returns for US bond investors haven't been this good in well over a decade. So that's the upside of downside. That's the good news if you're a bond investor. And if you believe that interest rates are going to go to 10%, yeah, you probably don't want to invest in the bond market. But if you believe that we're closer to the end of a rate hiking cycle, and perhaps we're actually going to see actually going to see rate cuts next year, then perhaps bonds become that much more attractive, and you want to lock in these longer term yields. So the answer, as always, is to have a balance in your portfolio. You want to have multiple different asset classes, multiple different bonds in your portfolio to encompass different scenarios. And no one's thinking about the scenario today where interest rates are falling. I understand that. But just think about a few years ago, no one was thinking about the situation of interest rates rising. So you always want to have something in your portfolio for the outcome that people aren't thinking of. So let's talk about the jobs report. Pretty good report once again. These monthly numbers, I don't want to pay a lot of attention to because they tend to be revised. They're so variable and they're so noisy. Any one month doesn't mean very much, but the broader trend is still up and positive. And we're seeing the good news is we're seeing a recovery in a lot of the areas that we need. So things like healthcare, we had a huge nursing shortage for a long time, and that's getting better. Leisure and hospitality, we had a shortage of restaurant bar workers, and now that's coming back. So that's good news. And so a lot of areas that have really needed workers and had a shortage of workers are seeing recovery. I think getting closer to where we were before March 2020. So if we look at the government sector here, you'll notice number 2 in terms of jobs added last month. And this is an interesting factoid here. We got public sector jobs as a percentage of payroll gains. Well, this year, almost 1 in 5 jobs created have been government jobs. That's the highest we've seen with data going back to 2009. And we're at 33 months in terms of consecutive payroll growth here. Does that mean that it's long in the tooth or it has to end? As you can see here, no, it can certainly go on for much longer. We had 100 consecutive months of payroll growth during the last economic expansion, which was by far a record high, but we certainly can see many more months to come of payroll growth. I think at least a few more months would be expected, looking at the number of job openings and looking at the very low number of jobless claims. It seems like there's still more demand for hiring in the months to come. And if we look at that unemployment rate, stayed steady at 3.8%, and we're still on the lower end of things. So 3.4% we had in April was the lowest since 1969, and 3.8% still historically low. And the Fed will be looking at this as a reason to kind of hold the line here. As long as the employment market is strong, they're still going to be concerned with inflation and probably err on the side of staying tight. So I don't see any reason for the Fed to think about cutting at this point, and they'll probably say that in the November meeting. And the question is, are they going to do another hike? Was this strong number that we got on the jobs front enough for them to say, well, we should do another hike? I don't think so. It seems like we're at about 70% now in terms of probability of no change. That's going to change. We still got a lot of inflation data in the next month, so we'll see how that shakes out, and that'll likely impact what the Fed does. But as of now, very well could see another hold from the Fed at the November meeting. So let's talk about real positive news in the labor market here. Looking at labor force participation rate among prime age workers, 25 to 54-year-olds, highest since May 2002, 83.5%. So if you're looking for a bright spot, it's that jobs are available and people are coming back to work. That should be good news for the economy overall, and it has been. And if we're looking at the pace of payroll gains, it's indicating that the labor market is continuing to loosen. So around a 2% increase over the last year. We're not, you had that huge number, 300 plus thousand last month, but just in context, 2% gain year over year in total payrolls. And that's kind of getting back to normal. And another way to look at that is simply to look at the wage growth number, and that has come down. Our hourly earnings 4.15%. That's the slowest rate of growth since June 2021. So the Fed's going to be looking at that, saying this is good news. Labor market is loosening here, and this should help inflationary pressures to kind of remain subdued here. And the expectation is CPI is going to sit in the next 2 months between 3.5% and 4%. And if we have changes around that, that will impact what the Fed does likely. But if it comes in in that range, 3.6, 3.7, 3.8%, then the Fed could very well just sit where they are. And the fact that hourly earnings are above the rate of inflation, I think that gives additional comfort as well. So lower prices here in the equity markets. It never ceases to amaze me. We talked about sentiment a lot in July and August, and saying how sentiment was getting a little frothy. If you looked at the number of bulls and versus the number of bears in the AAII poll, if we looked at the exposure of active managers, it got a little frothy, and there was good reason for that. We saw a huge rally in the markets, and people were optimistic, and we had the AI and all of that narrative going on as well. But it only takes a little bit of a sell-off to bring the bears back out. And in terms of the S&P 500, not a huge sell-off. It's about 8% decline off its recent high, but it's enough to push the percentage of stocks above the 50-day moving average. Is this one indicator I look at to say whether a market is oversold or overbought. And we got to just under 9% of stocks above their 50-day moving average this week, which is pretty extreme. You very rarely see it's around 98% of the time you're higher than this. So very rarely do you see the stock market being this oversold on a short-term basis. And the last time we saw it was back in 2022 before the market bottom back then. And what you tend to see historically, these are just probabilities, never certainties, is you tend to see snapback rallies following these extreme oversold levels. Now, how long are these rallies going to last? That part you absolutely can't predict, but all else equal, and all else is never equal, but all else equal, it's a better time for investors when the market's extremely oversold than when it's not. And it simply means that there's been a lot of selling, market's gone down a lot, and like a rubber band, when it gets stretched, it tends to snap back in the other direction. Now, during long bear markets, especially like we saw in 2008, it can get extremely oversold and then get more oversold and more oversold, and markets continue to go down. So this is not foolproof. There's no holy grail in markets, but just probability wise, when you have these extreme oversold conditions, you tend to get a bounce. And it will remains to be seen. We'll check back next week if we get a bounce and how big of a bounce that is. But better position today. I'm feeling better about the market today than I did when everybody was excited about it just a few months ago. And talking about that in terms of sentiment, it wasn't that long ago. S&P 500 was around 4,600 in July there, and we were talking about the active managers going levered long, and this was pretty rare thing. You don't tend to see them go over 100% exposure on average. And now we've had 8% pullback, S&P 500 at 4,200, and active managers now have only 36% exposure. And so that's a pretty dramatic reduction, I would say, in exposure. And so as prices have gone down, they've reduced exposure. So kind of the opposite again as what you should do as an investor. And if we look at the percentage of bears in this AAII sentiment poll, these are individual investors. We had very few bears when the market was high here, 20 something percent, and now we have 20% more bears. So I wouldn't say extreme in terms of negative sentiment by any means, but just fascinating to always see this when prices go down sharply. You see just sentiment can very quickly shift from being bullish about the markets to bearish. So where are we in terms of that drawdown? This is the biggest drawdown for the S&P 500 so far this year on a closing basis, just a little under 8%. Not huge historically. The average year has a 16% drawdown, median year 13% drawdown. So definitely nothing huge. S&P still up double digits year to date, but this is the biggest drawdown we've seen. And I think it would be a surprise to people, given where interest rates are today, that the drawdown is even bigger than this. I think that the resilience of large cap U.S. stocks is probably the more surprising thing. Like the fact that they're down 8%, I think people would understand that if we have a 5% 30-year yield and just what's gone on in the bond market. I think people would have expected a lot more pain, which Goes to show you very difficult to predict what the stock market's going to do. Even if you knew in advance that yields were going to rise as much as this, you probably would have said that there would have been a bigger drawdown, but that simply hasn't been the case. And historically, we've seen that before. We've seen the stock market do many different things with rates rising and rates falling. There's really no way to predict in advance what they're going to do based on the movement of interest rates. So let's talk about valuations here and when valuations matter. And uh, back during the mania, we heard this phrase a lot. Valuations don't matter. We heard that all throughout late 2020, 2021. But you hear it for individual securities as well in all different time periods. And so, whenever there's an extreme relationship in terms of valuation, people throw that out. Doesn't matter. Like this is different. It's a paradigm shift. Doesn't matter anymore. So I went back and just looked at an old tweet that I had on 3M talking about its price to sales ratio and how it looked kind of crazy back in early 2018. It had an enormous run higher, the stock, and it was trading at over 5 times sales, which for a company like that, which doesn't have a huge growth rate, was a pretty rich multiple. It was more than double the multiple of the market as a whole. And a lot of people were justifying it, saying, there's going to be incredible growth and it was such a valuable brand and all the rest of it. But today, that price to sales ratio is down at 1.5 times. So valuations mattered. They clearly mattered. You just didn't know when they were going to matter. And what has that done to the stock, this re-rating? Well, it's now down 58% from that peak in early 2018. This is the biggest drawdown in the history of this company, so not a small drawdown whatsoever. A lot of lessons for investors. One, there's no such thing as, this is a safe company. A lot of people would say this is a safe company, predictable revenues, predictable net income. But the bigger lesson is that when you pay such a rich multiple, everything has to go right. And if anything goes wrong, if anything unexpected happens in the future, then there's going to be problems. And with 3M, there's been a large unexpected events here in terms of these lawsuits that they've had over chemicals that they used, in terms of earplugs as well. So huge billions of dollar settlements that really changed the picture, right? In terms of this is costing this company billions of dollars in profits doing these settlements. And will there be more in the future? Who knows? But the broader point is in any individual company, there's this idiosyncratic risk. There's this risk of these bad events happening at some point in the future, and you can't predict them in advance. That's why diversification is key. And especially this is the case when valuations are out of whack. So when valuations are so high that people are pricing in everything going right, well, if anything goes wrong, then you have a big problem. And a few things have gone wrong with 3M. Will they continue to go wrong in the future? Nobody knows, but we know that investors today are not expecting very much from 3M. So you have the opportunity now for the opposite situation, that there could be an upside surprise. And so just time and again, investors love companies when they're doing well, when prices are high. They hate companies when they're not doing well and prices are low. I guess that will never change in terms of investing. That's just the way people are wired. So, talking about autos here, I want to talk about GM real quickly here, because it's in the news, of course, with the strikes, the ongoing strikes. They haven't stopped here, and I just pulled up a chart of GM, and this is probably surprising to you. Maybe it's not, but it's a little bit surprising to me. GM stock on a total return basis, so this includes dividends, has gone nowhere since 2011. So over 12 years, the stock is flat, and it's now down 54% from its peak in early 2022. So this is not a company that's hitting on all cylinders. So to me, this means they're probably going to be a little bit more reluctant to agree to a lot of the demands that we talked about in terms of those huge wage increases. I think the narrative from the union is this company's doing so well, it's making all these profits, and they're just not sharing it with the worker. I think this chart doesn't really line up with that story. This is not a company that has done exceedingly well over the last decade. And of course, if we compare it to Tesla, it's night and day, right? You have this company's made no gains at all to shareholders over the last decade plus, while Tesla has made thousands of percent return. And so it'll just be interesting to see how it plays out in terms of the negotiations, which are ongoing here. And just a broader point in terms of course, the strike I think is weighing on it, but interest rates as well have to be a huge factor. We're going to get data I think next week on new car financing rates, and they're expected to go up again. So the fact that most cars are financed, over 80% of new cars are financed, and financing rates going through the roof, this has to be impacting demand as well. And unlike Tesla, you're not hearing about price cuts from Ford and GM, at least not thus far. So demand is obviously collapsing. Uh, EVs, Rivian. Let's talk about Rivian here. This is always an interesting one. The Wall Street Journal had a interesting quote here that Rivian vehicles sell for over $80,000 on average. So not cheap. If you've seen, there aren't many Rivians around, but if you've seen one, maybe you knew this, but maybe not, that they sell for that much, over 80,000. So definitely not cheap by any means. And this is a crazy stat here. They're so expensive to build that in the second quarter, the company lost $33,000 on every vehicle that was sold. And that $33,000 loss, listen to this, is roughly the starting price of the base model Ford F-150, which is just mind-boggling. So they're selling this for over 80,000 on average, and they're losing 33,000. And the Ford F-150 is selling for 33,000. Just an incredible thing that they could be. The cost structure of this Rivian, at least for now, is such that they could lose money with such a high selling price. They could lose that much money. Now, Rivian has been losing. This is no different than when it came public. Rivian was losing money then. They're losing money now. So that fact hasn't changed, but investor expectations have changed a whole lot. And I wrote a piece back then when Rivian hit $150 billion market cap. I think I titled the piece something like "The Investors Are Behaving as If the Future Has Already Occurred." And what I meant by that was they were pricing in at the time not only everything going right, but everything already happening and happening well. So they were pricing in Rivian selling all of these millions of vehicles and making a profit on them and then some. So they were assuming all of that was going to happen. And what I said at the time is maybe that'll happen, but investors have already pulled forward that expectation today, so that even if it happens, as a shareholder, it's going to be very difficult for you to have any gains from that, because you're paying such a high price today based on that expectation. And since then, we've seen obviously a huge decline here. Went from 150 billion market cap down to 17 billion. And how is Rivian funding these losses? Well, they have to raise more capital. So just this week, the shares got hit after saying they're going to raise another 1.5 billion. So it's not cheap to make these things, and they have to their cash pile, I think that had around 10 billion, is being depleted every day, and they have to raise more money. And obviously, that's stockholders are not particularly happy about that. So we'll see what happens with Rivian. Just an interesting story there. So let's talk about the government debt situation. And you're probably saying, again, we're talking about this because I'm pretty much talking about it every week, but it's just, there's a new crazy thing that's going on pretty much every single week that I have to talk about. And this time it's that we've now increased the national debt by over $2 trillion since that debt ceiling was suspended just 4 months ago. So early June, we said no more debt ceiling, the sky's the limit. And the government has behaved as if the sky's the limit here. I mean, it's $2 trillion in a 4-month period. This is just Absolutely crazy. We went from 31.4 trillion in debt to 33.4 trillion in debt. Crazy amount of debt in a very short period of time. And again, very little focus. I don't hear anybody in Congress really trying to change this picture here. Where's all this money going? Obviously, an increasing percentage is going to have to be going to the interest payment on that. And so, with interest rates rising here across the board, that situation is accelerating, and no one seems to be focused on it or giving it the attention that it deserves, which I guess means that it's going to continue, as I've said, until it reaches some type of crisis level. So here's an interesting thing. If I told you a few years ago, 3 years ago, that we were going to increase the national debt by the amount we did, that we were going to print as much money as we did, and that we were going to have the highest inflation since the early 1980s, you would probably have said gold's going to do pretty well during that period of time. And a lot of investors did make that bet 3 years ago. Here's the interesting thing: gold is actually down 5% over the last 3 years. And the US dollar, which you might have imagined would have gone down in value given all of those things going on, the dollar index ETF is actually up 19%. So just a remarkable thing to see. And what's driving this in terms of gold going down? Well, the number one factor, I would say, gold is an enigma. First of all, it's almost impossible to predict where it's going to go in the short term. It has properties of commodity, a little bit of a currency. It's sometimes it's a safe haven. It's has almost no correlation to anything. The one big driver that I could find looking historically in terms of directionally what is problematic or what is helpful for gold, well, a sharp increase in real interest rates tends to be problematic for gold. And that's, of course, what we've seen. If we're looking at real 10-year treasury yields, we went from -1% to over almost 2.5% here. So over the last 3 years. So clearly this is weighing on gold. And why is this? Well, now you have an opportunity cost of holding gold. If you're going to be paid 2.5% above inflation for a treasury bond, you're less inclined to buy gold as, let's say, an inflation hedge. And obviously, the opposite is true if you're thinking you're not getting compensated, if you're getting a negative real interest rate. Well, then you might be more inclined to say gold is going to help me. So what's the direction of real interest rates in the future? Well, we don't know, which is why we can't predict where gold is going to go. And never mind the fact that this is only one factor that's influencing the price of gold, but just goes to show you how difficult macro is and how difficult investing is, that even when you think everything is lined up in one direction, like the dollar should be collapsing, gold should be doing well, and the opposite is going on. So I want to end with something positive, as I always do. And this week, I want to talk about air conditioning. And it's been a hot week in New York. In October, you don't tend to see 80-degree days, but this week we had that kind of weather. So thankful for having air conditioning. And what a difference in terms of the air conditioning situation in the US versus, let's say, 100 years ago. So 100 years ago, no households had an air conditioning. And today, over 90% of households have it. And if we look at the affordability since, let's say, 1950s and 1952, the average worker was making about $1.72 an hour, and you had the cost of a 5500 BTU air conditioning unit is $350. So in terms of what it would take to afford that, you would need to work 203 hours to earn enough money to buy that air conditioning unit. Now, fast forwarding to today, you have the average worker making almost $34 an hour in the US. And I just quickly looked at Walmart for a similar unit in terms of BTUs. So it's actually a little bit more here, 6,000 BTUs. But we have this unit slightly under $200 versus $350. And I'm sure this is a much more efficient unit, probably a lot quieter and probably a lot smaller than what you can get in 1952. But in terms of how many hours you need to work to afford that, back then in 1952 versus today, it's night and day. So 203 hours back in 1952, that's 5 weeks you would have had to work to make enough money to afford that unit. And today, less than a day, you're talking about 6 hours. So that's really, when I talk about prosperity, this is it in a nutshell. You're getting a better good at a lower price, and it takes less time to afford that good. And that's really been the story throughout the last 100 years plus in terms of global prosperity. And hopefully that's a trend that continues. So we'll leave it right there. Thanks everyone for joining me. Have a great weekend. As always, if you like the content, subscribe to the channel, and I'll see you next time on the Weekend Charts.